Have you ever looked at how the wealthy handle their money and wondered if they're playing a totally different game? Well, we're about to break down a playbook from real estate investor Pace Morby that claims to show exactly how to get a $0 tax bill. Let's dive in and see how this is even supposed to work.
All right, so the whole game plan kicks off with a pretty great problem to have. You've made $1 million in 1 year. Doesn't matter if it's from a business, investments, whatever. That $1 million figure, that's our starting point.
Now, for most of us, making $1 million means you're about to write a monster check to the government. According to the source, once you factor in federal and state taxes, you could easily be looking at a 40 to 45% hit. That's around $400,000, just gone.
But here's the crazy question that this whole strategy is built on. What if you could use the tax code, the rules themselves, to legally erase that entire bill? And we're not talking about evasion here. This is all about a specific strategy using the tax laws as they're written.
Okay, so the very first piece of the puzzle, the foundation for this whole thing, is all about the corporate structure. The big idea is to stop making money as just an individual and start running everything through a business. That one move apparently changes everything.
And the process he lays out is, on the surface, pretty straightforward. Step 1, create a business, like an LLC. Step 2, you start running all your expenses through that company. Not just your obvious business costs, but a lot of your personal spending too. And step 3, you deduct all of it from that $1 million income.
And this is where things get, well, pretty wild. The source gives examples like writing off your cars and gas, turning your family dinners into business meetings, calling your clothes a brand uniform, and even claiming a trip to Disneyland is an educational expense. Now, we gotta say, a lot of this stuff lives in a serious legal gray area and could definitely be challenged by the IRS.
So, what's the result of all this? Well, that first step does a ton of heavy lifting. In Morby's example, these aggressive deductions knock the taxable income down from $1 million to $700,000. So it's a smaller problem, but still, a $700,000 tax problem is a big problem.
All right, so how do you handle that leftover $700,000? This is where the playbook brings out the big guns: real estate. This is the main engine designed to create massive paper losses to wipe out that very real income.
The key tool here is something called a cost segregation study. Sounds complicated, right? But here's the simple version. You buy a property, and you hire engineers to basically break it down into tiny pieces. They identify stuff like carpets, light fixtures, even the parking lot, things that wear out way faster than the building itself. The tax code lets you deduct the value of those things much, much faster. This creates a huge instant deduction, a paper loss. You haven't actually lost any money, but on your tax forms, it looks like you did.
Let's walk through the exact example from the source to see this in action. The investor has that $700,000 of taxable income. They go out and buy a $3.5 million RV park. Then they do that cost segregation study, which lets them immediately deduct 40% of the property's value. You do the math on that, and boom, you've just created a $1.4 million tax write-off.
And just look at this. It's kind of crazy when you see it side by side. On one hand, you've got $700,000 of real, hard-earned income you need to protect. On the other, you've got this massive $1.4 million paper loss that you basically just manufactured for tax purposes. So what happens when that giant loss meets that smaller income? Well, it completely swallows it whole. Your final tax bill for the year? A big fat zero.
But wait a minute, what about all that leftover loss? You had a $1.4 million write-off, but you only needed $700K of it. Is the rest just gone? Nope. And this is a crucial part of the strategy. The extra $700,000 in losses can be carried forward to wipe out income next year and the year after that.
The source uses this quote to really drive home the next part of the strategy. It's not just about a one-off trick, it's about thinking several moves ahead, playing chess while maybe others are playing checkers.
Right, so if cost segregation was the main engine, think of bonus depreciation as hitting the nitro boost. This is another part of the tax code that basically lets you take a massive deduction for certain assets all in the very first year you buy them.
And this is where leverage becomes your best friend. Look at this example with tiny homes. The investor puts down just $70,000, that's 10% cash, to buy $700,000 worth of them. But thanks to bonus depreciation, they get to deduct the entire $700,000 purchase price in year 1. Same idea for other assets, like powerful computer chips for an AI business or even a heavy-duty vehicle. A small amount of cash out of your pocket generates this enormous tax deduction.
What you end up with is this incredible, almost self-sustaining financial loop.
The huge tax deduction wipes out your other income. The loan you took out to buy the asset gets paid down by the rent the tiny homes bring in, and in some cases, like with the GPUs, the source claims your small cash down payment can actually produce its own massive 30% annual return. It's pretty wild.
So we've talked about the how, right? The nuts and bolts of the strategy. But underneath all of these tactics is a really different mindset, a whole philosophy about wealth and taxes that's just on another planet from how most people think. And this quote is right at the heart of it. You should own nothing and control everything. What does that even mean? The idea is to use legal entities to build a wall between your personal identity and the things you own, both for tax reasons and to protect your assets. And this right here just lays out the two different worlds so clearly. On the left, you have the earner's path. You make money, you pay your taxes, and then you try to invest whatever's left over. But the investor's path, according to this playbook, flips that whole script on its head. You acquire assets first to create the deductions, you use those deductions to kill your tax bill, and then you get to keep all the income.
And this is how they actually pull off that own nothing, control everything idea. The source stresses that none of these assets, the RV park, the tiny homes, are held in a personal name. It's all tucked away inside this web of anonymous LLCs and trusts that separates the person from the property.
So after breaking all of this down, we're left with a pretty powerful question. This playbook seems to suggest that there are basically two separate tax codes in this country. There's one set of rules for people who earn a wage and a totally different set of rules for people who own assets. And it really makes you wonder, which one of those is the system actually designed to reward?